Hello, everyone. Let me just put some settings here. All right. Welcome, everyone. Thank you for joining us today. We will talk about the gold prices today. The central questions guiding the session is how will gold prices perform amid the ongoing geopolitical developments we have been seeing right now. So today we will cover three areas: the overall view of the United States economic backdrop, and a fundamental analysis of a key driver shaping the gold prices. And then we will move on to the live price analysis for the gold. Okay, so this is an important reminder. We are dealing with the CFD, and it carries significant risk. So please ensure you consider your own experience and risk tolerance before making any trade decisions. And please also ensure you only use official exchange channel for the communications and for the deposits on your personal accounts. So our objective for today is very clear. We want to dive into the macroeconomics and the fundamental drivers of gold to understand the current market conditions and what they could mean for the dollar pair's price outlook. So this is the agenda for today. So in part one, we'll provide an overview of the United States economy. And in part two, we will move into the fundamental analysis. And lastly, we will go live with the price analysis for the gold prices. So we will bring the macro and the fundamental picture all together with these parts with the live charts analysis. So, part one, overview of the United States. So, let's talk about the economic status of the US. We start with the leading economic index. We call this LEI, and this is one of the most comprehensive forward-looking guidance and the index of the United States economy activity. As you can see in the chart, the LEI has been in a sustained downtrend since 2021. And after the post-pandemic recovery, it has continued to decline, and this is a signal that the pace of the United States economic growth is cooling down. And the LEI is a composite of 10 leading indicators, and we will check in later parts. So it's persistent decline, and it tells us that the multiple economic engines in the United States are losing its steam simultaneously. And historically, when the extended LEI decline has preceded the slowdowns, and this is important context for the Fed's policy path, and therefore, of course, is very important for the gold prices as well. Now, a declining LEI does not automatically mean the United States economy is in recession. And the data here is actually more reassuring than the trend charts might suggest. So this chart shows the 6-month annualized growth rate of the LEI. And the red thresholds here, as you can see from here, this line marks the recession signals levels. So as of January 2026 here, the 6-month growth rate has recovered back above the recession signal zone, as you can see from here in the cursor. So the annotation highlights that the back in May 2020, the LEI did trigger a former recession signal, and it matches the COVID downtrend. But currently, Neither the 6 month growth rates nor the diffusion index is breaching those thresholds. I mean, in the red level. So while momentum is cooling down, the former recession signal has not been triggered. So the economic recession risk remains low for now, but we should be cautious about it because it is worth watching closely because of the geopolitical risks. We have some kind of risk for the US labor market, and of course, with the inflation rising. And we will cover this in the later parts. Okay, so what is actually dragging the LEI lower? So this chart breaks down the components contributions for the January 2026. Sorry, So the single largest drag is the consumer expectations for business conditions, and it pulls the LEI down by minus 0.22 in January alone, and by almost 1.2%, minus 1.2% over the past 6 months. And that is by far the biggest narrative contributor on the chart, as you can see from here in the black colored bars. So this has been a persistent pattern since mid 2021. And when consumers feel pessimistic about the US economy outlook, they pull back on spending, and that feeds through to slower growth over time. And other notable negatives includes the building permits and new orders. But on the positive side here in the above, the financial components like the S&P 500 index and the leading credit index are still contributing very positively, and it provides some offsets for this bottom parts of the data. And let's turn into the labor market. This is one of the uh, most key mandates for the Fed, I mean the central bank, and this is the latest NFP data, and it tells an encouraging story for the United States economy. So the US NFP rose by 178,000 in March, and it beats the expectations and it reverses the prior month weakness. As you can see from here, this is the prior's weakness and this is the current numbers. So the gains were very broad-based and it was led by the healthcare and some kind of constructions market. So looking at this chart, the NFP were volatile through 2025 and with several negative months as well here, August, October, and February. But the March rebound here, it reinforces the view that the United States labor market remains fundamentally resilient. So a strong job market gives the central bank, I mean, to the Feds, some room to keep the rates higher for longer. And as we will discuss shortly in the later parts, that has direct implications for the gold prices. And this is the main reason. If you are trading the gold, you should very look carefully and cautious about the NFP data. So while the NFP were strong, the wage data provides a more broad pictures for the gold prices. So the U.S. Average hourly earnings increased at 3.5% year over year in March, and this was the slowest pace since 2021. So the facts, I mean, the central bank's perspective, this is a welcome development because slower wage growth reduces one of the key inputs to services inflation, and it has been one of the thickest components of the overall price index. But the 3.5% is still above the level consistent with the fast 2% inflation target. So basically, and generally, central bank usually set up the target, I mean, the inflation target to around 2%. So 3.5% is well above the central bank's inflation target. So the progress are being made here, as you can see from here, but it is not yet a level that gives the central bank, I mean, to the Fed, a clear reasons to pivot toward the rate cuts yet. Yeah, and this is the unemployment rate. So the United States unemployment rate has been holding in a narrow band of around 4.3% to 4.4% recently. And this is uh, consistent with the resilient but gradually softening US labor market. So the rate here did not edge higher from its, I would say, mid 2025 lows, but it still remains historically low. So from the Fed's standpoint, this level of unemployment rate is not alarming yet. So the labor market, I mean, the U.S. labor market is losing its steam, but not deteriorating, which is roughly the soft landing the Fed has been aiming for right now. So if you are a gold trader, a stable unemployment rate that keeps the central bank rate on hold is generally and usually a headwind, and it reduces the probability of near-term rate cuts that would boost up the gold prices. So, like I said in the previous slide as well, if you are a gold trader, you should also watch the NFP and CPI, I mean the inflation data, and also with the unemployment rate data as well. So, like I just said, this is the most important part, CPI. I mean the PCE, sorry. So, core PCE, this is the Fed preferred measure of inflation, and it has been rose to 3.1% YOY, and it marks a 2-year high here, 3.1%. So this is a meaningful reacceleration. So after appearing to trend lower through middle of 2025, uh, inflation has resumed climbing, and at 3.1%, it is well above the Fed's 2% target. So this is a key reason why markets are no longer pricing in a near-term rate cuts. So the persistent inflation above the target locks the Fed into a higher for longer stance, and it traditionally it creates a headwind for the gold, and it raises the opportunity cost of holding a non-yielding asset, which is the gold we are talking about right now. And adding to the inflation concerns is the PPI data. And this is core PPI, and it excludes the food and energy prices, which uh, shows a lot of volatility. And it rose to 3.9% YOY in February here. And this is the upstream cost pressure that eventually fits through to the consumer prices. So I would say current geopolitical risks and the significant rise in oil prices might affect the PPI as well. So when producers face the higher input costs like this, they tend to pass those kind of costs along to the consumers. So alleviated PPI, I mean, the rising PPI is often on very early warning signs for the future PCE and future CPI readings. So this chart shows a clear uptrend since mid 2025 here, as you can see from here, starting from August, has been rise consistently. So combined with the core CPI data here we saw here, uh, this points to entrenched and building the inflation, and it reinforces the case for the Fed to stay hawkish. We have checked about the inflation concerns so far, and the consumer spending has held up very well. The US retail sales rose to 0.6% MOM month over month. And this is a broad based rebound that surprised the market and surprise to the upside. And it signals that the American consumers still remain very active. So this is a double-edged sword because strong spending does support the growth, but it also adds to inflationary pressure and it makes it harder for the Fed to justify their rate cut stance. So if you are a gold trader, a resilient consumer that keeps inflation elevated and the Fed rate on hold is a net negative in near term, though it does speak to the underlying strength of the economy that could eventually support the risky assets. And let's take a moment to bring the US economic data together before we move into the fundamental analysis of gold prices. So the picture is one of resilience with the complications. So the strong job growth in the United States and consumer spending are positive, but they are being offset by the persistent inflation and early signs of labor market softening. So the growth remains supported for now, but the sticky inflation and a more hawkish Fed stance continue to pose some kind of trouble, and particularly for non-yielding assets like gold. So that naturally leads to the questions on screen. Now, what does all of this have to do with gold prices? And starting from now, we will find the answer step by step. So this is a part two, fundamental analysis. Now that we have the macro backdrop, let's look at the specific fundamental forces that are directly shaping the gold prices and gold market right now. So the gold price is currently being shaped by the three interconnected forces. So this is the most important slide. So please, if you are a gold trader, please pay attention to these slides. So first here, geopolitical tensions, which is like particularly ongoing in Middle East right now. So this ongoing conflict has alleviated the energy prices, I mean oil prices, and created the broader inflation risk, as I told you in the previous slides, and which at the same time drives the safe haven demand for the gold. And second, this is the Fed policy. As we have just seen, the persistent inflation has shifted market towards a higher for longer Fed stance. And higher interest rates increase the opportunity cost of the holding gold, and it creates a structural headwind for the gold prices. And third, US dollar strength. And this is very important because it directs to the gold prices. So a stronger dollar makes the gold prices more expensive for holders of other currencies, and it reduces the global demand. So when the dollar rises, gold generally and typically faces some kind of selling pressures. So these three factors, I mean, these three forces are currently in tension with each other, with the geopolitical risk supporting the gold, while the dollar strength and the Fed policy weighed on it. So that kind of tension is part of why we have been seeing the alleviated volatility in gold prices these days. And we will look at the things about these three factors step by step. And this slide shows us what the FedWatch tool is saying about the market expectations for the Fed's upcoming FOMC meeting. So as of 7th April 2026, 2 days ago, markets assign a 99.5% probability that the Fed hold rate steady at the current 3.5 to 3.75% range. And there is essentially zero probability priced in for a rate cut. So in fact, there is a small but notable 0.5% probability of a rate hike, and it indicates that some participants see some kind of upside risk to the rates, not downside, and which is because of the inflation worries and concerns because of the current oil price. So to compare that to 1 month earlier on March 6th, when there was still a 17% probability priced in for a rate cut to the 3.25 to 3.5 range. In just 4 weeks, the rate cut expectations have been almost entirely removed from the market. So this rapid repricing reflects the combination of strong payrolls and the reaccelerating inflation we have just reviewed in the macro parts. So for gold traders, this is very important that the Fed that is firmly on hold, steady on hold, is a clear near-term headwind for the gold prices. So if you are a gold trader and if you are very highly paying attention to the gold price and gold's price movements, you should, like everyday basis, you should go to the CME FedWatch tool and to check how the market is betting and how the market is putting the probabilities on the next Fed FOMC. And this chart overlays the gold price in yellow here with the US dollar index in blue. And it illustrates one of the most important structural relationships in macro markets. As I said, there is a high connectivity between the dollar index and gold prices. So for most of the period shown, the gold and the dollar moved in opposite direction. And this is a classic inverse correlations, I would say. And when the dollar strength was alleviated in the 2014 to 2016 period, gold was suppressed. And as the dollar weakness, as the dollar weakened through the 2020s, gold prices staged a sustained rally, as you can see from here in this chart. So the red dots here, red dashed box highlights the most recent period. And here the picture becomes more complex. The gold price surged to record high, even as the dollar index rebounded. And it suggests that the safe haven bid from the geopolitical tension was temporarily overwhelming the dollar's index headwinds. However, more recently, gold was pulled back from those peaks as the dollar has firmed up, and consistent with the traditional inverse relationship reasserting itself. So it is also very worth noting that the side points out the central bank selling gold defend their currencies, such as Turkey Central Bank, which we will look at the next slides, adds an additional layer of selling pressure on gold prices recently. So besides the dollar index and with the geopolitical tensions, I think the central bank's gold reserve is one of the most important part to examine and to evaluate the current gold prices. This is a powerful illustrations of how the geopolitical conflict creates unexpected selling pressure in the gold market recently. And following the start of the regional conflict, so the Turkish central bank sold and swapped approximately 60 tons of gold recently, and it's worth over 8 billion US dollars in just 2 weeks, and it's specifically to defend their currencies, lira. And you can see the impacted clearly in this chart. So the Turkish central bank net gold reserves have been steadily building for years and reaching above 560 tons in early 2026. Then around 20th of March 2026, the gold reserves dropped sharply, falling to around 500 tons almost overnight. So this kind of emergency central bank gold liquidation is a reminder that the gold is not just a passive safe haven asset recently, it is also a reserve asset that the countries can and do sell under pressure. So besides the Turkish central bank, there is a Polish central bank and also PBOC, People's Bank of China. You should see the data carefully on their gold reserves and gold liquidations because sometimes it signals the future gold prices. And this that will be the very important signals uh, to look for if you are taking a very close look on the gold prices. Okay, so besides the central banks selling, I mean the gold selling, there has been a wave of liquidations in the gold ETF recently. So according to the World Gold Council data, gold exchange traded funds (ETF) experienced sharp outflows in March 2026, and insurance holding by nearly 90 tons in a single month. And as you can see in this chart, that the outflows were broadly based across the regions. North America saw particular large outflows, and European and Asian flows also turning negative. So the scale of these outflows, 90 tons in a month, is very significant, and it helps explain some of the recent price weakness from the highs. So, like I said, along with the central bank's gold reserves, you should also check the gold ETF data if you are trading the gold prices. The final piece of the fundamental picture here is a speculative positioning on COMEX, and this is the US future exchange. And this chart shows the COMEX net long positioning in tons, which represents the combined bullish bets by money managers and other speculative players in the gold future markets. So net long positions have declined notably from the highs since in late 2025, and it falls from around 700 to 800 tons to the current range of approximately 500 tons. And this tells us that the speculative convictions in gold has been fading away. But the longer term structure level of net long remains elevated relative to historical norms. And this also suggests that while the short term enthusiasm has cooled down a little bit, the broader bullish structure for the gold has not been forgiven, I mean, abandoned. So think of it as the hot money has stepped back, but the core long term positioning remains intact. Okay, so I think this is all that I prepared. So let's bring the fundamental picture all together. So the gold's near-term fundamentals are being shaped by the three forces we have just reviewed: geopolitical risks, the Fed's rate path, and the United States US dollar index movements. So there is a potentially supportive development, a two-week ceasefire agreement, and the temporary reopening of the Hormuz routes. And if sustained, this may ease some of the energy driven inflation risks, and it could reduce the pressure on the Fed, and it eventually provides some support to the gold prices. So I would say this is a very complex situation, and the balance between the geopolitical safe haven bid and the macro headwind from the dollar and the Fed will continue to be the key driver to watch. So if you are a gold trader, you should be cautious about the current volatility of the dollar index, and you should also cautiously check about the geopolitical headlines. And like I said, there will be a lot of changes of the Fed's the rate stance on behalf of the change of the rate path. I mean the rate probabilities that I showed you in the Fed Watch tools. Okay, so I hope that this helps you in the fundamental sides. Putting all this together, listen will take you to the live chart analysis. So if you have any questions related to the gold, related to the dollar index, of course, and if you are trading the other instruments, and if you have any questions, please feel free to chat on the box, and she will happily answer your questions. Thank you.
Thank you, Inky. Right, so for the next part, like what Inky shared, we will be taking a look at the live charts. So if you guys have any questions, if you have instruments you want us to analyze, right, please just put it in the chat box. Okay, so I'm going to share my screen and we should be seeing the Exynos web terminal in a moment. Just give me 1 second. Okay. Okay, so I hope you can see my screen. Right, so as what we always do, right? We want to start from a top-down approach. So the idea is that we will take a look at the technical analysis from a higher time frame first. We take a look at it from a monthly, weekly perspective. We try and find if there are any key levels that, price could potentially be testing on the bigger time frame. And then we use the lower time frame confirmation to find potential setups. Okay. So we have a few questions coming in, right? So before I go to the analysis, let's just take a look at these questions. So how much effect by Okay, so sorry. The first question, it's US oil, right? Can US oil affect gold prices? I would say that it's more of the inflation risk that comes with higher energy prices. Okay, so with regards to your question, it's not so much of the US oil, but just in general, because of the Middle East tensions driving oil prices higher, there is a lot of concerns around inflation. And if inflation is high, right, then that's when Fed would be forced to either hold interest rates higher for longer periods of time. And then that in turn would impact gold because gold itself, it's what we call non-yielding. So it doesn't generate interest, right? Which means that when interest rates are high, right, your opportunity cost for holding gold would be more expensive in a way, right? So the US oil prices will directly affect inflation concerns, and that would drive or impact gold prices. Okay, so it's like what Inky shared earlier, it's more of expectations of the Fed, and that is what has been driving the gold price drop lately, right? Another question, right? How much if impact by war gold price? Okay, so this is a very interesting question because I think intuitively, right, when we take a look at gold, gold has always been seen as a traditional safe haven, right? So when there are geopolitical uncertainties, as we have seen last year, right, you can see that there was a very strong rally in gold, partly driven by all this, like, tariff uncertainties and also this global headwinds. But this year is slightly different because of the Middle East conflict and also higher oil prices, right? Market focus more on inflation and the risk of, inflation coming back again, right? And forcing central banks to essentially hold interest rates higher, right? That's what has been weighing on gold prices. Okay, is there any strategy that work on goal like fair value gap or moving average, right? So as all this, we will share in a moment like our analysis, but the idea is that, when we take a look at, it doesn't have to be goal, but just any kind of analysis, right? You want to look at it from the higher time frame where prices could potentially be going, and then use that higher time frame narrative to frame your lower time frames. Okay, so don't just go in and look at, oh, price is holding above a fair value gap. Okay, then this means that it's going to go up or go down, but rather you want to combine it across different time frames. Okay, so once you have that narrative, Ashan, it doesn't really matter what you are using. You can be using moving average if your trigger is based on, RSI, Bollinger Bands, other indicators. It's more of looking at the higher time frames direction, and then you use this lower time frames once you've confirmed market structure, you see that prices are going to move higher, then you can use moving average as a trend following indicator on the lower time frames. Okay, news time trading. Okay, what about news time trading? So I would say that in general, right, depending on what kind of trader you are, if you're more of a fundamental driven trader, you have a certain bias, right, then maybe you want to consider news time trading, right? But personally, just to share my personal experience, it's not financial advice, right? I'm basing it mainly on technicals. So when it's news, especially high impact news events, then we can see much more volatility and that cause whipsaws. So generally, I don't. But again, right, like I said, it depends on your style. Okay. Yeah, okay, so let's take a look at it, right? So Inky's answering your questions, right? So if you guys have questions, just send them here and we will take a look at our goal analysis. So we take a look at it from a higher time frame perspective first. Okay, so you can see on the monthly, let's take a look at it on the monthly. So on the monthly, like we've shared in the previous week's analysis, right? We were waiting for price to close above the previous month's low. So let me just remove all of this. So you can see just a monthly perspective, right? Where we are right now, it's interesting because previous month, so this is March, right? March has actually swept below February's low. You can see this, right? So it took out the low, but it didn't actually close below it. And if you go down to the weekly, you can see this very clearly as well. We have a swing low that was being formed in January, right? Oh, sorry, in February, and then price moved up. And then during March, right, we saw that whole move to the downside, very much driven by that inflation risk, right? Especially with the geopolitical tensions. So you can see, excuse me, you can see that price just wick below the swing low. And then right now we're seeing some kind of slight rebound. Okay, so nothing much, right? It's worth noting on the weekly, you want to mark out your potential areas or potential resistance and support levels, right? So you can see this swing high over here for a start, right? This is the last swing high that we have. We have a swing low over here, right? So on the higher time frames, I'm really just marking out key levels and then use these areas to guide the lower time frames direction, okay? So on the weekly, you can see that we are also sitting at this potential, this fair value gap that price is testing over here. This is on the weekly time frame. I'm going to mark this in purple, right? You can see this fair value gap. Again, for the benefit of those who are not familiar with fair value gaps, right? It's basically 3 consecutive candles. And you can see that these 3 candles, for example, right? The wick of the first candle and the wick of the last candle doesn't overlap. So it creates some kind of imbalance, right? So over here, you can see this gap, right? So this, when we take a look at it just based on previous data, you can see that this could serve as potential support or resistance zones. So that's the idea. On the weekly, it's also worth noting that price has tested last week's high. You can see here, right? So I'm on the weekly time frame because it's easier to see price movement on the higher time frame. You can just compare the previous candles, so it's easier to gauge. If you are more comfortable, you can go down to the lower time frame. You see more price action more clearly. Okay, let me just give me a moment. I'm going to hide this EMAs because we're not using them here, right? So you can see here, like what I've marked out earlier, this is last week's high, right? So what we have is some kind of break in structure on the 4 hours time frame. But on last week's candle, you can see price hasn't closed yet, right? Because we're waiting for the end of this week. So, price is still moving, but it's just worth noting that price has already moved above this swing high, which is the last week's high. We don't know if it's going to close above it, right? That depends on the lower time frames, but we cannot call for any reversal here yet, okay? So on the weekly, that's pretty much, right? And then when we go down to the daily time frame, so you can see on the daily time frame, right? What we have is that you can see when price took out the weekly high, right? We have this slight retreat to the downside. Okay, you can see this here. So right now I want to focus our attention on this price movement, this area, right? So on the daily, a few things to note, right? One, it's of course, right? The move to the upside, if I were to zoom in, you can see this very clearly, right? Yesterday, when price moved to the upside, it actually wick above the previous day's high over here, didn't close above it, and then we saw that slight retreat. So you see this even more clearly on the 4 hours time frame, right? So price took out previous day's high and then we saw the slight move back to the downside. And then what's also worth noting here, if I were to go back to the daily, it's that you can see the previous day's low has been taken also. So this is a classic move of here, right? So imagine if you have a swing high, price push to the swing high, just wick slightly above it, and then it goes back into that swing low, the previous day's low, and it takes this out too. Okay, so if I were to go to, let's say, the 1 hour, you can see this range more clearly. So we have a swing high over here, which price took out, and then price moved lower for the rest of the day. And then eventually today, it actually took out the previous low here. Again, right, whether it's some kind of liquidity sweep or not, we need to wait for some kind of confirmation. Okay, so this is where we are, right? So on the 1 hour, there are a few things to watch. First, it's that we have the swing high, which is the previous day's high, this area, as a buy side liquidity, this area over here. And then we see price took out the swing low. We want to wait for confirmation. And the confirmation can come in forms of a market structure, right? So the idea that when price is going to form higher lows and higher highs, it's ready to go higher. If not, right, we could still be seeing some kind of consolidation. So that's my thought process right now, right? So on the 1 hour time frame, you can see here, right, we are seeing price pushing into this. Not so much actually, I would say it's breaking below this fair value gap. It's actually going, if you go to the 4 hours time frame, yeah, you can see that price is not really holding, I would say maybe this area, right? So not so much of the fair value gap, right? So it's not really interacting with any of these zones, because if I were to mark out the fair value gap that we have here, you can see that price has broken below it, this area, right? So you're kind of in this potential resistance zone, again, depending on your lower time frame. That's one. And then we have price taking out the previous day's low, but that's pretty much, right? So nothing much on the daily. Now let's move down to the 1 hour time frame. So on the 1 hour, you can see that this area over here, so we are somewhere here. So you can see what happened, right? At the end of, this is the end of the day. Let me just mark this up. Okay, so here. So you can see this is the start of a new day, right? This was the previous day. And then today, price actually swept the previous low, right? And then it moved higher. So now it creates a potential support level over here. You can see this zone. Because price broke above it, it could potentially test this region again. Or if you want to be even more, how do you say, if you want to highlight a broader zone, then this would be the zone for me, because it's the last move that we have to the downside for price breaks above it. If you look at it in terms of candlestick patterns, you can see this as well, right? You can see this last swing high. So when we take a look at market structure, right, this is a potential region to watch. Not saying that price will bounce off this, but if price does come into this level, I want to see how it interacts with this zone, right? So more of that. So we're now in London session. So you can see here, right? This area. Actually pushing into New York AM session. Okay, so over here what we have, right? You can see we have a few swing highs over here, this area on the way up. So for me right now, right, depending on New York session, right, whether we could see a push back into this zone, this H1, right, support zone, then you will see something like that on the lower time frame. Then again, you want to observe if price form lower swings, if we do see that rebound, and you can target the latest swing high as a potential support, right? So if order flow is bullish, if we are seeing, higher swings being formed and then price respecting fair value gaps along the way up, then, the higher time frame, we could be seeing price pushing into this buy side liquidity here. Okay, so that's one, right? Of course, we must always take a look at the opposite scenario as well. What happens? Because it's still forming, right? Price hasn't closed today, so we are not sure if it's going to be liquidity sweep or price could just break this altogether. So if price does break this zone, right? If it breaks below this, then I want to see again if it's going to hold as a resistance, and then if there is potential to move towards this previous swing lows. Okay, so that it's let me just take a look at the questions if you have any questions, right? But that is the analysis that I see right now on Go, right? If you guys have any questions, just send them there. Send us here, right? Okay, I think we have no questions, so it's good. Okay, and then the next one that we want to take a look at, right? We will take a look at the dollar index. Okay, if you guys have any chart requests you want us to analyze as well, right, just put it in the chat. Okay, so here, let's take a look at dollar index, because dollar index is directly impacted by mainly Fed expectations, right? And also it's a safe haven. So when, tensions escalate, then that is when we will see strong demand for dollar index, like what we saw over the last few weeks, right? Yeah, so that it's that okay, so we'll take a look at dollar index, right? Okay, I have a few questions here, right? What key factors should we keep in mind for scalping, right? Again, I would say that scalping really depends on what is your higher time frame narrative, right? So for example, if you are scalping on a 1 minute time frame or 5 minutes time frame, maybe you want to look at, if we're seeing any kind of liquidity sweep on the Asia session, London session, so on and so forth, and then you use that, right, to guide your lower time frame order flow. So if you're scalping, you don't have to go to the monthly, the weekly, because it takes some time for that to play out. But the idea is that, you need to base it off a higher time frame. Maybe let's say if Asia cycle has taken out Asia's low has been swept, right? Then you want to wait for, let's say, maybe its price coming back into a support zone or demand zone, and then you can target the last swing high or Asia's high. So you want to break it down based on this different time cycles. Okay. So yep, so hope that answers your question. Okay. So let's take a look at other questions, right? Okay, so recording for it, right? So recording, okay, right now we are still sorting out some stuff, right? But if everything goes through, then we should be posting a recording on YouTube, so you can check them out there, right? Analysis on gold, yeah. So I do think that too, right? So the question is my let me see. Yeah, Mohammed's analysis on gold, its bearish direction. It will fall till 4,000, go 3,700, right? So like what I shared earlier, right? I do think that from a higher time frame perspective for gold, right? Let's say if you take a look at it here, you can see from a higher time frame perspective, right? We still have this swing low over here as a potential level. But right now, right, if this is the previous month, you can see that this is the previous month and price has already taken out the previous month's close. If on the lower time frames, right, it shows that it's ready to move higher over here, right? This for me would be an immediate support zone. You can see this zone over here. So if price does push into this level, right, it's a area that I want to watch. So instead of just giving specific targets, right, I want to see at key zones, how price interact with the zones, right? On the lower time frame, what are we seeing? Right? Is it ready to go higher or lower? So, yep. So just like what I shared earlier, right, that it's on the 1 hour, you can see those are the potential zones that we've highlighted. Okay. Okay, we have another question. Okay, yeah, according to the higher time frame. So yeah, I would say that if it's based on the higher time frame on the monthly, but I want to see price actually close below this. So on the monthly, there's still no bearish indication for me at the moment, right? Just because you can see that even on the weekly, right, apart from this fair value gap over here, right, there are no indications that price is reacting to it yet. So, depending on, again, your analysis, but for me, like just based on this, right, I want to see very clear signals that price either from lower swings, it's ready to go higher to show that it's respecting this higher time frame fair value gap, which I'm not seeing at the moment. Okay. Okay, what is the most crucial factor to consider when opening and holding a position in the daily time frame to capture the next swing, right? That price doesn't retrace to my entry point once left. Okay, this is a very interesting question, and I was just exploring this recently. But the idea that, so for me personally, right, I use liquidity sweeps as a potential trigger. It can be based on anything, right? But the idea is to have, kind of a higher time frame narrative. So for me here, right, for example here, right, okay, let's take a look at this, right? So this is the monthly. You can see that this is the swing low. And then if you move down to the daily time frame, you can see how that this is basically the last move to the downside that we see, right, before a strong rally up. So this area would serve as a support zone. So the idea is that if the order flow is bullish, right, price should not be breaking below this level. So just using, answering your question as to, what if price doesn't retrace to my entry point, right? So using that analysis, right, if this is my support zone and if order flow is bullish, right, then it should hold above this. So then if price does enter into this, right, and I see on the lower time frame, it starts forming this higher swings on your lower time frame, then it shows me that the lower time frame has confirmed this higher time frame as a support zone to target a swing high or like a buy side liquidity. Okay, so I would say that come from the most immediate level, right? So after liquidity sweep, right, what is the first support zone that you found? And if that is the level, right, price should hold above it as long as the opposite side has not been reached, if that makes sense, right? So here, for example, let's say here, right, we take a look at an example so it's easier to explain. You can see when price actually took out the previous month's high here, you can see this, right? If I were to zoom in, you can see here, right? So price actually went above the previous month's high and it moved lower. So this whole move that we have to the downside, you want to focus on this price action here. You go down to the weekly or even the daily. So you can see that if order flow is bearish, right, you're going to see a few things. You'll see lower swings, right, lower lows and lower highs. You can see that even in a line chart, right, just lower lows and lower highs. So this tells you that here at this point, you can see when price broke to the upside and then it moved back down, right? This is the swing high that it took out. It created this level. Sorry, let me get, where is the box? Yeah, here. Right, you can see here, right? This fair value gap as a resistance. Can see how that following that liquidity sweep, right, price actually acknowledged this fair value gap as a resistance. And as long as order flow is bearish, it should continue to hold below this resistance level. Right. So if you're using higher time frame analysis, right, I would say that maybe you can take a look at, how price react when it actually goes into, the previous month's high or low, right? If we're seeing some kind of sharp retracement, and on the lower time frames, you see that resistance levels are being respected, then you can target the next swing low, right? On, whichever time frame that you're on. Okay. So hope that answers your question. Okay. Let's see, right? Sorry, I'm just reading through them because we have a bunch of them coming in. US 100 hourly chart. So let's take a look at that. How may it impact the move? And also, okay, so US 100 fit retracement strategy. When a big move it's coming or not. Okay, so those are okay. So to answer the when a big move is coming or not, bullish or bearish, right? Again, it depends on what kind of trader are you? Are you looking at technical analysis or are you looking at fundamental analysis? And which time frame are you trading on? Because big is very subjective, right? Big, if you're on the daily time frame, right, a small wick maybe doesn't mean as much as compared to, let's say, if you're scalping. But most of the volatility might be driven by high impact news events or geopolitical headlines, right? So for example, if you have NFP releases or FOMC interest rate decisions, you can see those would cause, price to be a bit more volatile. Or even just like recently, with the markets just monitoring, what is the status of the ceasefire? Are we seeing the agreement being adhered to? Those kind of stuff. Okay. Okay, US 100. Let's take a look at US 100. Right. Actually, I think this is US tech, right? Yeah. Okay. Let me just close this. I have reached the maximum number of tabs, so I just need to close one of them. Sorry, give me a moment. Just loading this. I don't know, for whatever reason, I cannot close it. So just one moment, please. Right. We're seeing a bunch of questions coming in, so we'll try our best to answer as much as we can. But okay. I don't know if I can load this. And for whatever reason, I cannot actually. Just give me one moment. I need to reload this. Yes. Okay. Okay, there we go. Okay, so again, from a higher time frame perspective first, let me just make a copy of this. Okay, so from a higher time frame perspective on US tech first, and we're just going to remove all this. Right, so you can see on US tech on the monthly, right, despite that slight retracement, we have a few things here. One, it's this area. You can see this, right? So we have a swing low that has been formed over here, which hasn't been tested yet, this area, right? And then you can see previously, we have some kind of liquidity sweep happen on the monthly. You can see how this is in January, right? So January actually took out December's 2025's high, and then we saw that strong move to the downside. If you take a look at it on the weekly time frame, we can see that when price took out this high, it created this move. You can see this move to the upside before price moved back down, right? So this area, this bullish candle before the strong move. And this for me, it's important because, right, we saw that liquidity sweep, and this area, if price doesn't break above this, right, then we could see some kind of retreat. So on the weekly, right, so this is the weekly resistance, right? Again, this is the higher time frame. So which means that, when price is pushing into this level, right, I want to go into my lower time frames, be it your daily H4. I want to see that price is ready to move lower, right? Has it formed lower swings? Has it, maybe form some kind of lower swings or some kind of liquidity sweep on the lower time frame before it actually goes lower? Right, so that's the thought process. Doesn't mean that price comes into this level and I'm taking short positions, right? That's not what I'm trying to share, right? And then if you take a look at it on the daily, right, it's worth noting on the daily, right, we have this move to the upside. You can see that actually yesterday, right, was a very kind of muted or flat movement that we saw because price briefly wicked to the upside, and then right now we're just kind of consolidating over there. That's on the weekly, this area here, but there's still no kind of confirmation on the 4 hours whatsoever, right, for this bearish move. So I would say that it's slightly more choppy, right? It's also worth noting that if you move down to the 1 hour time frame, you can see this area, right? You have this resistance or this fair value gap, which price tested once into this level. Right now, we are potentially pushing back into this zone again. On the lower time frame, right, this is potential liquidity, right? So if price does push into this level, right, again, you'll observe higher swings into this level on the lower time frames, right? If it moves lower, then you could target this lower swings that were being formed on the lower time frames, right? Again, if price continues to form higher swings, right, and this holds, then it could break this zone altogether. So which is why I think lower time frames are important because it gives you a key into how prices are reacting here, right? You can see on the 5 minutes, if I were to go down to the 5 minutes time frame, right, just based on this recent move, you can see that price, when it's pushing into this zone, right, it's just forming this higher lows and higher highs. Okay, so for me, in terms of the 1 hour time frame, 4 hours, right? Again, depending on where you're looking at, right? 4 hours hasn't really there's no confirmation of any sort for me, right? 1 hour, there's potential resistance level over here. Again, I'm not taking any immediate positions, but rather I want to see how price interact when it pushes into this zone. Okay, so these are the key levels for me. Okay, and then there's another one, right? On retracement. I think I saw a fib retracement, right? Fib retracement strategy, in short, is it useful? Okay, so I think fib retracement, right? The idea is that, you want to understand the idea of premium and discount zones, right? So if, let's say, for example, if I'm this bullish move, right? Higher lows and higher highs to the upside, right? Just imagine if you are looking to buy into this move, right? What happens is that this is a strong, let's say, strong bullish move, right? And then price would retrace. So when you mark this zone, the high and low, right, there is like a premium and discount zone. So let's say if you are bullish, you mark this zone, right, which means that when price actually goes below 50% of this move, then you are buying it at a discount. Also to say, right? So that's the concept, right? And then so what happens is that when we're looking for this retracements on the higher time frames, you want to see that ideally if price pushes into this 50% or below it, right? Then again, you observe this lower time frame. So it's not just specific fit retracement strategy, but again, combining it with different all the other concepts. Okay, so yeah, so I hope that helps. Okay, okay, one more question, and then because we need to end the session soon, right? Interested in improving my scalping strategy, timeframe liquidity market structure. Can you please explain timeframe liquidity market structure, break of structure, or the block fair value gap for high probability entries, right? So okay, this is perfect because actually from next 8 May onwards, right, we are actually going to be sharing more on this, right? Price action concepts, right? So like what you shared earlier, right? Break of structure, if you take a look at, fair value gap. So if you take a look at just how you can actually understand higher time frame analysis and combine them, right? So this is what we will be focusing on for the actually from next week on next 2 weeks onwards, right? So from May onwards, we will be pushing out this price action concept so that there's more clarity on this, right? So if you guys want to join our webinar, right, you can actually let me see where I can get the link, right? But you can actually sign up for this sessions, right? So it'll be on price action concept. I believe you can see them in the PA area, okay? And keep a lookout for emails as well because we do share them via EDMs. Okay, any strategy? Yeah, and yeah, so for the videos, right, we will be posting them on YouTube mostly. Okay, so yeah, so that's all right. Thanks everyone. Right, thanks for keeping the session so engaging and for all your questions. We hope that they have been helpful. And at the end of the session, we have a 1 minute survey, right? So it's just a few check boxes to just give us an indication of what you like because we're tailoring these topics according to your feedback. So you know what you would like us to focus on, and also maybe instruments analysis of these instruments you'd like us to see. Okay, so that's all we have for today, right? Thanks everyone. Have a great trading week ahead, and we'll catch you guys again soon.
Thanks, everyone. Bye bye.